The stock market has seen an incredible rally, and among the top players, Apple has continued to dominate headlines. But how does its valuation and profitability compare with other members of the Magnificent Seven, NVIDIA, Meta, Google, Tesla, Microsoft, and Amazon? Today, we break down the numbers over the past 8 quarters to see if Apple still holds the crown or if another tech giant is taking the lead. Data for this analysis is sourced from alphastockai.com. For a more comprehensive deep dive, check out their platform. Let's start with valuation. Apple has long been a favorite among investors, but its valuation metrics suggest that it trades at a premium compared to its peers. Its price-to-book ratio has averaged nearly 48 over the last 8 quarters, significantly higher than Microsoft and Meta, which have stayed under 10. Even NVIDIA, despite its meteoric rise, has a lower average PB at around 52. This suggests that Apple is commanding a price well above its tangible assets, reflecting its strong brand and investor confidence. Looking at enterprise value to EBITDA, Apple stands at an average of 97, meaning investors are paying nearly 100 times its earnings before interest, taxes, depreciation, and amortization. This is notably higher than Google and Amazon, which average around 65 and 72, respectively. While this signals that Apple is a high-quality business, it also raises concerns about whether its valuation has become too rich relative to earnings. The price-to-earnings ratio tells a similar story. Apple has traded at an average PE of 33, while Meta and Google have stayed in the low 20s. This means Apple investors are willing to pay more per dollar of earnings compared to its competitors. Meanwhile, Tesla, often criticized for its sky-high valuation, has seen wild fluctuations in its PE, though Apple's valuation remains more stable. Investors need to ask, is this premium justified, or is the market pricing in too much optimism? Now let's shift to profitability, where Apple has historically excelled. Over the last 8 quarters, its net profit margin has averaged 25.9%, peaking at 29.2% in Q4 2023. While impressive, NVIDIA has outperformed significantly with an astonishing 52.7% margin, fueled by the AI boom. Microsoft also leads with a 35.7% average, while Amazon and Tesla trail at 7.2% and 10% respectively. This highlights Apple's strong profitability, but also shows that competitors like NVIDIA are achieving even greater efficiency. Apple's gross profit margin, consistently around 45%, reflects solid pricing power, but Meta and NVIDIA have both outshined it, with margins above 74%. This indicates that despite Apple's premium pricing on devices and services, other tech giants are achieving even better cost efficiencies. Return on equity is another metric where Apple shines, reaching 54.4% in Q4 2023. This far outpaces Microsoft and NVIDIA, showing Apple's ability to generate strong shareholder returns. However, Tesla's return on capital employed has been surprisingly strong, peaking in recent quarters as the company aggressively scales production and expands margins. So, is Apple still a strong investment? The numbers suggest that it remains a high-quality, highly profitable business, but its valuation premium demands scrutiny. In the short term, rising PE and PB ratios signal that the stock could be overvalued relative to its peers. Investors seeking immediate gains might find better value in Microsoft, Meta, or Google, whose valuations appear more reasonable. But for long-term investors, Apple's strong brand, consistent profitability, and dominant ecosystem make it hard to bet against. Ultimately, the decision comes down to risk appetite. If you're looking for a steady compounder, Apple remains a safe bet. But if you're chasing high growth potential with better valuations, NVIDIA, Meta, and Google may offer more attractive opportunities. Stay informed, analyze the data, and for a deeper breakdown of these financials, visit alphastockai.com.